Let me tell you something that most investors get completely wrong about recessions. They think recessions are the time to hide, to run to safety, to stuff their money under the mattress, and wait for the storm to pass. That is the worst thing you could possibly do. Recessions are not the time to hide. Recessions are the time to get rich. I have made more money during recessions than I have made during bull markets. And today, I am going to share with you the only 3 stocks I would buy if a recession hit tomorrow. Now, I want to be very clear about something from the start. I am not predicting a recession. I do not know when the next recession will happen. Nobody does. Anyone who tells you they know exactly when the economy will turn is lying to you or deluding themselves. But I do know that recessions happen. They are a natural part of the economic cycle. And when they come, the investors who are prepared, who know exactly what they want to buy at what prices, those are the investors who build generational wealth. I learned this lesson in 2009. That was the year that changed everything for me. The world was falling apart. Lehman Brothers had collapsed. The banking system looked like it was on the verge of complete failure. Unemployment was skyrocketing. Home prices were crashing. Every single day brought new headlines about which company was going bankrupt next, which bank was about to fail, how much worse things were going to get. And I remember sitting in my office looking at stock prices. That seemed impossible. Bank of America was trading under $5. Citigroup was under $2. Companies that had been worth hundreds of billions of dollars were trading like they were going to disappear. Most investors were selling. They were panicking. They were getting out at any price just to stop the pain. But I saw something different. I saw opportunity, massive generational opportunity, because here is what I understood that most people did not. The banks were not going to fail. The government was not going to let them fail. They had already shown their hand with the TARP program, with the bailouts, with the Federal Reserve flooding the system with liquidity. The message was clear if you were paying attention. These banks would survive. And if they survived, they were trading at ridiculous valuations. So I started buying. I bought Bank of America. I bought Citigroup. I bought AIG. I bought everything that looked like it was going to zero, but actually was not. And in 2009, my fund returned over 120%. I personally made about $4 billion that year. $4 billion, not because I was lucky, because I was prepared, because I knew what I wanted to buy, and I had the courage to buy it when everyone else was running away. That experience taught me everything I know about recession investing. And today, I am going to share that knowledge with you. I am going to tell you the 3 specific stocks I would buy if a recession hit tomorrow. And more importantly, I am going to tell you why. Because understanding the why is what allows you to have conviction. And conviction is what allows you to buy when everyone else is selling. Before I get into the specific stocks, let me give you the framework I use to identify recession opportunities. Because not every stock that falls in a recession is a good buy. Some stocks fall because they deserve to fall. Some companies actually do go bankrupt. The skill is in distinguishing the babies that get thrown out with the bathwater from the ones that actually belong in the trash. The first thing I look for is survivability. Will this company still exist when the recession ends? This seems obvious, but you would be amazed how many investors buy stocks during recessions without asking this basic question. They see a stock down 80%, and they think it is a bargain without considering whether the company might go to zero. A stock that is down 80% can still fall another 100% from there if the company goes bankrupt. So I look at balance sheets, I look at debt levels, I look at cash flow generation, I look at whether the company can service its debt even if revenues fall significantly. I look at whether they have access to capital markets if they need additional funding. The companies I buy during recessions are the ones where I am absolutely certain they will survive. Not pretty sure. Certain. The second thing I look for is cyclicality with quality. I want companies whose earnings decline during recessions but bounce back strongly during recoveries. These are typically industrial companies, financial companies, consumer discretionary companies. Their earnings are tied to the economic cycle. When the economy is weak, they struggle. When the economy recovers, they thrive. That cyclicality creates the opportunity. But within that universe, I want the highest quality companies, the ones with the best management, the strongest competitive positions, the most durable franchises. Because when the recovery comes, and it always comes, the best companies in cyclical industries recover the fastest and go the highest. The third thing I look for is valuation compression, beyond what is justified by fundamentals. During recessions, fear takes over. Investors sell indiscriminately. They do not distinguish between companies that are in serious trouble and companies that are just experiencing temporary earnings declines. This creates opportunities where great companies trade at valuations that would be impossible in normal times. I am looking for companies trading at single-digit price-to-earnings ratios, at significant discounts to book value, at valuations that imply the business is permanently impaired when it actually is not. These are the opportunities that create 5 times, 10 times returns over the subsequent recovery. Now, let me tell you about the 3 stocks I would buy. The first stock is Bank of America. Now, I know what you might be thinking, banks again, after what happened in 2008. But here's the thing. The banking system today is dramatically different than it was before the financial crisis. Capital requirements are higher, risk management is better, the system is more stable, and Bank of America specifically has transformed itself into one of the best-run large banks in America. Let me tell you why I love Bank of America in a recession scenario. First, the survivability question is not even close. This is one of the largest banks in the world with over $3 trillion in assets. It has a fortress balance sheet with capital ratios well above regulatory requirements. It passed every stress test the Federal Reserve has thrown at it. Even in the worst-case recession scenario, the Fed models, Bank of America remains well capitalized. This bank is not going to fail, period. Second, the business model is incredibly valuable. Bank of America has over 60 million consumer customers and over 3 million business customers. It has one of the largest deposit franchises in America. Those deposits are incredibly sticky. People do not switch banks very often. And those deposits provide low-cost funding that the bank can lend out at higher rates. That spread is the core of the business, and it is durable through economic cycles. Third, and this is what really excites me, Bank of America is incredibly sensitive to interest rates. When rates rise, their net interest income expands dramatically. When rates fall, it compresses. In a recession, the Federal Reserve typically cuts interest rates aggressively to stimulate the economy. That would hurt Bank of America's near-term earnings. But here is what most investors miss. They would sell the stock because of the near-term earnings pressure without recognizing that lower rates also stimulate the economy, reduce loan losses, and set the stage for the next expansion. So in a recession, you would likely see Bank of America stock fall 40, 50, maybe even 60% from peak levels. The market would be pricing in lower interest rates, higher loan losses, reduced lending activity, and the stock would look terrible. That is exactly when I would be buying. Because here is what happens next. The recession ends, the economy recovers, the Fed eventually raises rates again, and Bank of America's earnings explode higher. The stock could easily double or triple from recession lows over the subsequent 3 to 5 years. That is the kind of return profile I am looking for. I would want to buy Bank of America at a price to tangible book value below 1. Historically, in severe recessions, it has traded at 0.5 to 0.7 times tangible book. At those levels, you are essentially buying the assets for less than they are worth on a liquidation basis, and you are getting a world-class banking franchise for free. That is the kind of value that gets me excited. The management team under Brian Moynihan has been exceptional. He took over after the financial crisis and completely transformed the bank. They cut costs ruthlessly. They exited businesses that did not make sense. They improved the technology infrastructure. They built a culture of responsible banking. The Bank of America of today is not the Bank of America of 2008. It is a much better run, much safer, much more profitable institution. Let me give you some specific numbers that illustrate why Bank of America is such a compelling recession play. They have over $2 trillion in deposits. Think about that for a moment. $2 trillion sitting in their vaults, earning them the spread between what they pay depositors and what they charge borrowers. That deposit base is not going anywhere in a recession. People might worry about banks, but they are not going to pull their money out of one of the largest, most stable banks in America. That funding base is permanent and incredibly valuable. Their wealth management business alone manages over $3 trillion in client assets. That generates fee income that is relatively stable through economic cycles. Rich people do not suddenly fire their wealth managers during recessions. If anything, they lean on them more heavily for advice during uncertain times. This business provides a floor under earnings that most investors do not fully appreciate. And the technology investments they have made over the past decade are paying off enormously. Their mobile app has over 40 million active users. Digital banking reduces costs and improves customer satisfaction. These are advantages that compound over time and create barriers to entry for competitors. Smaller banks simply cannot match the technology infrastructure that Bank of America has built. Now, let me tell you about the second stock I would buy in a recession. This one might surprise you because most people do not think of it as a value stock. But in a recession, it absolutely becomes one. The second stock is Disney now. Before you dismiss this, hear me out. Disney is one of the most valuable media and entertainment franchises ever created. They own intellectual property that is irreplaceable: Marvel, Star Wars, Pixar, the Disney animated classics, ESPN, ABC, theme parks around the world, cruise ships. This is not some speculative tech company. This is a 100-year-old business with assets that cannot be replicated. But Disney is also highly cyclical. When the economy is strong, people go to Disney World. They go on Disney cruises, they buy Disney merchandise, they subscribe to Disney Plus. When the economy is weak, they cut back on all of that. A family that might have spent $10,000 on a Disney vacation decides to stay home instead. Advertising revenue at ESPN and ABC declines as companies cut their marketing budgets. The whole business feels the pain. This cyclicality is exactly what creates the opportunity in a recession. Disney's earnings would decline significantly, maybe 30%, maybe 40%. The stock would fall in anticipation of those lower earnings. Analysts would downgrade it. The media would write stories about how streaming is struggling, how theme park attendance is falling, how the magic is gone, and the stock could easily fall 50% or more from peak levels. That is when I want to buy, because here's what I know about Disney that the market forgets during recessions. The intellectual property does not go away. Mickey Mouse does not disappear because the economy is weak. The Marvel characters do not lose their appeal. The Star Wars franchise does not become worthless. These assets have enduring value that transcends any economic cycle. And the theme parks are essentially irreplaceable. You cannot build a new Disney World. The land alone would cost tens of billions of dollars. The brand equity built up over decades cannot be replicated when the economy recovers. And it always recovers. People flood back to the parks. They have been dreaming about that Disney vacation during the hard times. And when they have money again, that is where they spend it. I have studied Disney's performance through multiple recessions. Every single time, the stock gets hammered during the downturn and then comes roaring back during the recovery. In 2009, Disney stock fell to around $17. Within 5 years, it was over $100. That is nearly a 6 times return for investors who had the courage to buy during the panic. The key to buying Disney in a recession is understanding normalized earnings power. Do not look at what they are earning during the recession. That is depressed. Look at what they earned before the recession and what they will likely earn 2 or 3 years after the recession ends. If you can buy the stock at 8 or 10 times normalized earnings, you are getting a world-class franchise at a bargain price. I would want to buy Disney at around $60 to $70 in a recession scenario. At that level, you would be buying the company for less than 10 times normalized earnings and getting all the growth optionality for free. The streaming business, which is still being built out, the new attractions being added to the parks, the content pipeline, all of that upside would come at no cost. Let me explain something about Disney that most investors miss. The theme parks are not just entertainment. They are essentially toll roads on happiness. Every family that has young children dreams of taking them to Disney World at some point. It is a rite of passage in American culture, and Disney has pricing power that is almost unique in the consumer discretionary space. They raise prices every single year, and people keep coming. Attendance dips temporarily in recessions, but it comes roaring back as soon as the economy improves. The parks also generate enormous cash flow that gets reinvested into new attractions, which drives future attendance. It is a virtuous cycle, Galaxy's Edge at Disneyland and Disney World. The new cruise ships they are building, Avatar Flight of Passage. These investments draw people to the parks and justify higher ticket prices. The competition simply cannot match the depth of intellectual property that Disney brings to these experiences. And think about the cruise business for a moment. Disney cruise ships are consistently rated among the best in the world. They have a customer loyalty rate that is off the charts. People who have been on a Disney cruise want to go again, and they are building more ships to meet that demand. This is a growth business disguised as a recession victim. When the economy is weak, people postpone their cruise. When the economy recovers, they book immediately. The pent-up demand after a recession is enormous. ESPN is another asset that gets undervalued during recessions. Yes, cord cutting is a secular trend. Yes, they are losing subscribers to streaming, but ESPN still has the most valuable live sports programming in America. Live sports are the one category of content that people watch in real time with commercials rather than recording and fast-forwarding. That makes ESPN's advertising incredibly valuable. And as they transition to streaming with ESPN Plus and the upcoming flagship streaming product, they have multiple paths to monetize their content. Now, let me tell you about the third stock. This is the one I am most excited about because it combines everything I look for in a recession investment: strong balance sheet, cyclical business with quality, and massive valuation compression potential. The third stock is Caterpillar. Caterpillar makes heavy equipment: bulldozers, excavators, mining trucks, diesel engines. When the economy is booming and companies are building, they need Caterpillar equipment. When the economy is in recession and construction stops, Caterpillar's sales fall off a cliff. This is one of the most cyclical businesses in the world, and that extreme cyclicality is precisely what creates the opportunity. In a typical recession, Caterpillar's revenue can fall 30 to 40%. Their earnings can fall even more because of operating leverage. The fixed costs of running their factories do not go away. So when revenue falls, the losses at the bottom line are amplified. This earnings volatility scares most investors away. But here's what those investors do not understand. Caterpillar has been through this cycle dozens of times. They know exactly how to manage through recessions. They cut costs, they reduce production, they manage working capital, and they maintain their dividend because they understand that their shareholders are counting on that income. Through the 2008 financial crisis, through the 2020 pandemic, through every recession since the company was founded, they have never cut their dividend. That is a commitment to shareholders. That means something. The balance sheet is rock solid. Caterpillar has investment-grade credit ratings and access to capital markets whenever they need it. They have a financing arm that provides credit to customers, which creates a recurring stream of interest income. And they have a services and parts business that is much more stable than equipment sales. When times are tough, customers might not buy new equipment, but they still need to maintain and repair their existing equipment that provides a floor under earnings. Let me tell you what happens to Caterpillar in a recession. The stock typically falls 50 to 60% from peak to trough. That is not an exaggeration. In 2008 and 2009, the stock fell from around $85 to under $25, a 70% decline in the 2020 pandemic. It fell from about $150 to under $95 in just a few weeks. Those are the moments when I am buying aggressively, because I know what comes next. When the recession ends, infrastructure spending picks up, mining activity increases as commodity prices rise, construction rebounds, and Caterpillar's earnings explode higher. The stock can easily triple or quadruple from recession lows over the subsequent 3 to 5 years. In the recovery from 2009, Caterpillar went from under $25 to over $115 by 2012. That is nearly a 5 times return in 3 years. In the recovery from the pandemic lows, it went from under $100 to over $350. More than a 3 times return. This is the kind of opportunity I am looking for in a recession. A world-class company with a fortress balance sheet, temporarily depressed earnings, a beaten-down stock price, and a clear path to massive earnings recovery when the economy turns. I would want to buy Caterpillar at around $120 to $150 in a recession scenario. At those levels, you would be buying the stock at less than 10 times normalized earnings, with a dividend yield approaching 4% and exposure to some of the most important themes in the global economy: infrastructure spending, mining, energy, construction. All of these will recover and grow when the recession ends. Let me tell you something about Caterpillar that most investors do not appreciate. Their brand is one of the most powerful in industrial equipment. When a construction company or mining operation needs equipment, Caterpillar is the gold standard. Their machines are more reliable, have better resale value, and are supported by the most extensive dealer network in the world. That dealer network is essentially irreplaceable. Competitors cannot just build thousands of service locations overnight. It took Caterpillar decades to create that infrastructure. The aftermarket parts and services business is a hidden gem within Caterpillar. When you buy a Caterpillar machine, you are locked into their ecosystem for parts, maintenance, and service. That creates a recurring revenue stream that is much more stable than equipment sales. In a recession, companies might not buy new machines, but they still need to keep their existing machines running. That services revenue provides downside protection to earnings. And think about the long-term demand drivers for Caterpillar's products. Global infrastructure spending is increasing, not decreasing. Developing countries are building roads, bridges, airports, power plants. Developed countries have aging infrastructure that needs replacement. The energy transition requires enormous amounts of mining for copper, lithium, nickel, and other minerals. All of this means more demand for heavy equipment over the coming decades. Now, let me bring this all together and explain the strategy for how I would actually execute these trades in a recession. First, I would not try to time the bottom. Nobody can time the bottom. If you wait for the perfect moment to buy, you will miss it. The bottom only becomes obvious in hindsight. Instead, I would scale into positions as prices fall. Maybe I buy 20% of my intended position when stocks are down 30% from their highs, another 20% when they are down 40%, another 30% at down 50%, and the final 30% at down 60% or more. This scaling approach accomplishes several things. It ensures I am buying into weakness, which is emotionally difficult but mathematically correct. It prevents me from going all in too early if the decline is more severe than expected. And it forces me to buy more at lower prices, which improves my average cost basis second. I would focus on quality. During recessions, many stocks are down 50 or 60%. Some of them deserve to be down that much because the underlying businesses are impaired. Others are down that much purely because of fear and indiscriminate selling. I only want to buy the latter. That is why all 3 stocks I mentioned, Bank of America, Disney, Caterpillar, are high-quality businesses with strong balance sheets and clear paths to recovery. I am not bottom fishing in speculative garbage. I am buying world-class franchises at temporarily depressed prices. Third, I would be patient. Recessions do not end overnight. They can last 12 months, 18 months, sometimes longer. The stock market usually bottoms before the economy does, but you do not know that in real time. So I would be prepared to hold these positions through continued economic weakness and stock price volatility. The returns come from the recovery, which might be 2 or 3 or even 4 years away. You need the patience and the conviction to wait. Let me also talk about what I would not do during a recession. I would not panic sell. This is the single biggest mistake investors make. They hold through the early stages of the decline, hoping for a bounce. Then as the losses mount, the pain becomes unbearable. They sell at the worst possible moment, near the bottom, just when they should be buying more. Do not be that investor. If you own quality businesses, hold them if you have cash. Deploy it into the weakness. Do not let fear make your decisions. I would not buy speculative garbage. In a recession, everything is on sale. Speculative companies that were trading at ridiculous valuations might be down 80 or 90%. It is tempting to think they are bargains. They are not. Many of them will go bankrupt. Many more will never recover to their prior highs. Stick with quality, stick with companies that have proven business models, strong balance sheets, and clear paths to recovery. I would not use leverage. This is critical. Leverage kills in recessions. If you borrow money to buy stocks and the market falls further, you face margin calls. You are forced to sell at the worst possible time. The leverage that amplified your gains on the way up destroys you on the way down. Use only cash you can afford to have locked up for years. Do not borrow a single dollar. I would not try to get too clever. Some investors try to hedge their positions during recessions, buying puts or shorting other stocks to offset their long exposure. This usually backfires. The hedges cost money. They are hard to size correctly, and they often expire worthless just before the market recovers. If you have done your work and you are buying quality at good prices, you do not need hedges. You just need patience. Now let me address a question that I know many of you are thinking. What if we are not going into a recession? What if the economy stays strong and these stocks never get cheap enough to buy? That is entirely possible. Recessions are impossible to predict. We could have another 5 years of economic expansion. If that happens, these stocks will likely continue to appreciate, but more slowly than the broader market, because they are already fairly valued. You might feel like you missed out. But here's how I think about it. Preparation has no cost. Having a list of stocks you want to buy at specific prices does not require you to do anything until those prices are reached. It is a plan that sits on the shelf until it is needed. And when it is needed, when the recession comes and everyone is panicking and stocks are falling, you will be ready. You will know exactly what to do while everyone else is frozen with fear. I have had watch lists like this for my entire career. Sometimes I wait years for the prices I want, sometimes I never get them. But when I do get them, when the market hands me world-class businesses at bargain prices, I am ready to act. And those are the trades that make careers. Those are the trades that build fortunes. Let me share one more insight about recession investing that took me decades to fully appreciate. It is about the psychology of buying at the bottom. When stocks are at their cheapest, when the valuations are most attractive, that is precisely when it feels the worst to buy. Everything in your body is screaming at you to sell, to get out, to protect yourself. The news is terrible. The economy is falling apart. Every expert is predicting more pain ahead. This is the fundamental paradox of value investing. The best opportunities come when things feel the worst. If you wait until things feel good, until the economy is recovering, until the news is positive, you have already missed the best prices. The market is forward-looking. It bottoms before the economy does. By the time things feel safe to buy, the stock has already doubled from the lows. I have trained myself over decades to embrace this discomfort. When buying feels terrible, when my stomach is churning, when every instinct says to sell, that is when I know I am probably making a good investment. Not always. Sometimes the market is right and things really are getting worse. But more often than not, maximum pessimism marks the bottom. This is why I emphasize doing the work in advance. If you have already analyzed these companies, if you already know their balance sheets are strong, if you already know they will survive, if you already know the normalized earnings power, then you can buy with confidence even when everything feels terrible. You are not relying on your emotions in the moment. You are relying on the analysis you did when you were thinking clearly. Let me close with a story that illustrates why this approach works. In 2020, we had the fastest bear market in history. In just a few weeks, stocks fell over 30%. The pandemic was spreading. The economy was shutting down. Nobody knew how bad it would get. I had my shopping list ready. I knew exactly what I wanted to buy at what prices. And when the market crashed, I started buying aggressively. Bank stocks, airline stocks, industrial stocks, companies that were getting destroyed because of the temporary shutdown, but would clearly survive and recover. Within 18 months, most of those positions had doubled or tripled. The pandemic ended, the economy recovered, the stocks I bought at the bottom became some of the best trades of my career. Not because I predicted the pandemic, not because I knew exactly when the market would bottom, but because I was prepared, I had a plan, and I executed it when the opportunity arrived. That is what I want for you. I want you to be prepared. I want you to have a list of world-class businesses you would love to own at the right price. Bank of America, Disney, Caterpillar. These are just my picks. You might have different ones. The important thing is that you know what you want to buy and at what price before the recession hits. Because when the next recession comes, and it will come eventually, the investors who are prepared will have the opportunity of a lifetime. The investors who are not prepared will panic sell at the bottom and watch from the sidelines as others get rich on the recovery. Which investor do you want to be? The choice is yours. But I am telling you from 4 decades of experience, the time to prepare is now. Not when the recession hits. Not when stocks are already crashing. Now make your list, know your prices, be ready to act. And when the opportunity comes, take it. That is how fortunes are made, not by predicting the future, by preparing for it.